Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Mike Zlotnik. He is a former political refugee from USSR who is now an American citizen and a patriot, and he's been a real estate fund manager since 2009. And before that, he was a software executive who began real estate investing in 2000. So going into 3 decades here. And Mike manages various real estate funds today, including multiple growth and income-focused funds. So thank you so much for coming on today, Mike, which I know people also call you in this space Big Mike by your podcast as well that you run.
Thank you, Charles, for having me. I appreciate the opportunity to be here.
So give us a little background on yourself, both personally and professionally, prior to getting involved with your software engineer career and becoming a real estate investor for that first time, which is nearly 25 years ago now.
Yeah, time flies when you're having fun. Life moves. Yeah, originally from the USSR, and moved and lived in upstate New York, in Rochester, New York, with my mom. She just passed away, unfortunately. But educated in the U.S., have a degree in mathematics, went into the computer science and software, spent almost 15 years in that field, had a successful career, but discovered real estate in 2000, investing passively in New York City of all places. And it became pretty obvious that it actually works. You don't get much income in New York. The cash flow is terrible, but the appreciation has been healthy. Well, had been healthy. Now things are a little different. But they enjoyed that. And then 2009, I went real estate full time, sort of semi coincidental, but I was burned out from the technology industry and really discovered it was my passion. I really love real estate. Nothing wrong with technology. That's a great world. Just more of a find the job that you like, or the career that you like. You have to work a day in your life. So it's been a journey, a growing tempo, family of funds, and we started funding flips after 2008. If you remember, there was a market correction, and we funded a lot of short sale flips. Then we went to hard money loans. Then we went into a number of commercial syndications and deals, and we continued to expand our horizons of commercial and residential loans, as well as a lot of interesting commercial equity and commercial debt. And we continue to evolve with times. So that's kind of the adventure. But I do live in Brooklyn, New York now, with my lovely wife, and I have 4 wonderful kids and a cat. 4 monkeys and a cat.
2008 was quite the time. I started investing in multifamily real estate in '06. And in '08, even the private lenders that I had that were still in the game of some sort at that point, 2008, 2009, 2010, I mean, they weren't really lending. I mean, they lend it, but it was like, I mean, if you're lending less than half, 50% or something loan to value, I mean, that's not really, I mean, it's just, even at that time, it was just, I mean, that doesn't really help much, with certain things. So it was, how did you get involved with that? Like, how were you, what kind of projects were you doing? Was it, you said fix and flip. So it's meaning like 1 to 4 units. Were you guys doing anything else that you were lending on? Anything that could be resold? Is that what you were focusing on?
Oh, we had the fortune of getting involved after the bottom of the crisis. So we started lending effectively in 2009, and we really funded short sale flips. Originally, these were ABC transactional funding deals, where folks locked up a deal on a short sale for 300,000 and flipped it immediately for 350. We just provided flash funding, 1, 2, 3 day funding. After that, banks started to put anti-flip restrictions. We went into the extended funding, 30 days, 60 days, 90 days. And leverage, of course, was low leverage. So lending business has been a good business because of the conservative market conditions for lending for many, many years. Of course, it's evolved over the years. What we're seeing now, sort of resurrection of more conservative lending today. And interestingly enough, as we saw this market correction with high for longer interest rates on the equity front, lenders tightened up a lot. Both bank lenders and private lenders have stepped in to substitute. So actually, right now is a great time to be a lender because you can charge high interest rates and you can push lower, more conservative leverage loans forward. So from that perspective, it's a very interesting time. Market goes in cycles, and that's we saw sort of a cycle of credit tightening then, and now it's again bank credit tightening, but it's an opportunity for private capital to replace where the bank money could be playing.
Yeah, it's interesting how lenders work like that. when it's the worst of times is actually one of the best times to lend, and it's kind of like counterintuitive, but it's difficult for people that are lending in a box, like lenders in a box, because back when we were flipping properties, '08, 2009, stuff like this. It had to be something that we knew it could be sold for FHA. It was like we went in there and did like an FHA inspection on, because that was really the only end game you had. Properties we were buying ourselves to hold, you could buy, small commercial properties, because there'd be no, you could really steal them from the banks because there was no funding available, right, for those deals. But what we found was that just everything went into, if we had any question that it wasn't going to get FHA in the back end, like that first time home buyer that was going to buy this, it was like, it's gone. Like there's no, we're not taking any of that risk on that. And that's kind of how those years went, I think. And I imagine that's what your people that you were funding, who they were selling the properties to.
Yeah, exit in mind always has been a key question up front. So for sure, a lot of these deals were either flipped to cash buyers because
Mm-hmm.
discounts were so large. They were cash buyers, or if you were operating at the lower end of the spectrum, and yes, FHA was the most attractive product, 100%, even to closing costs. So it did exist. It did exist, and I remember those loans. It's been so many years ago, but we definitely thought about, if we're originating a loan and it's going to be 90-day hold,
Yeah.
how are we going to get repaid? And it had to be obviously a flip to a called retail buyer. A lot of them were using FHA, correct?
So you mentioned before about how when you left software, you found out that real estate kind of was your true love. What were some of the things? There's so many things you can invest into, but why was real estate something that drew you in? That maybe you want to make this a full-time career?
Well, real estate is very, very powerful from the point of view you could be passive, truly passive, versus a lot of other investments are active or semi-active. And I did like the passive components just from an investing side. For a lot of investors who write a check, what do they want? I mean, they go through, look through the fancy underwriting and other criteria, but at the end of the day, it's the cash flow and appreciation, right? It's those two things that most investors care about. Real estate obviously has all kinds of tax benefits, depreciation, amortization, all the fun stuff, many other benefits. On the active front, why I went into this on the active front is because a lot of decisions are very, very logical. As a mathematician, I'm also a chess master. So being a very logical person, you could look at deals in a systematic and organized manner, and you can analyze and you can see what's going to happen. Predictability. So you don't have, nothing is guaranteed in life. There's risk in everything. But real estate investments in general, in comparison to, for example, stock market, have significantly higher predictability. So the outcome is mathematically, you could project what's going to happen. Even today, even with difficult underwriting, uncertainty where the interest rate is going to go, you can still do sensitivity analysis and look at things today and say, hey, here's a range of possible outcomes. Can things work in a conservative outcome? And if they can, then you can consider writing a check. So really just the key that appealed to me is predictability. You can analyze, you can understand like the scenarios. Of course, markets move up and down, there's cyclicality, there's black swan events, a lot of things that do happen that don't always happen, but normally under the normal market conditions, real estate is very predictable.
That's true. Very true. So, can you give us an overview, kind of what your Mike, currently, what your firm's fund offerings are, kind of what your strategy is behind your business, because it's a little different from other groups out there that are raising funds and buying income producing properties.
Sure. So we are capital partners. The best way to describe what we do, our strength is sort of marrying money and opportunity. We are not active operators. So we run funds that invest into other deals. We do loan money directly. We do invest in some projects directly, but we don't want to operate assets. So as a lender, I'm perfectly happy to loan because we're not the owner. Somebody else is operating the asset. And if we want to be in the equity, we do want to have partners who operate the assets. So that's kind of our high level allocation. Uh, the term that you might hear sometimes called fund of funds. We're not a classic fund of funds because we don't necessarily invest only in other funds. We do some investments in other funds and then other syndications. So I think the audience is familiar with one-off multifamily syndications. We do write check in that strategy. What we do, our biggest strength and benefit is we're programmatic investors. We write larger checks. We can step on sponsor toes a little bit more, ask for more. So what our value is, we enhance returns for our investors through our relationships. And as a lender, of course, that's direct relationship. And we love lending. In today's environment, as I said, it's a great time to be a lender. And you ask what funds we operate. So we currently have two open funds that raise capital: Tempo Income Fund and Tempo Advantage Fund. Tempo Income Fund we've had for multiple years. It's a more conservative, income-focused fund. It does a lot of hard money lending. It does first lien loans. We do some more creative finance, what is known secondary lien, mezz financing, obviously at a much higher interest rates. On the projects where we feel highly comfortable not being in the first position, but we underwrite them conservatively. So lending is what we do in the fund. Plus, we do income-oriented equity strategies, which is not easy to do in this environment when we have high cost of debt, but they do exist in certain subsectors. So we've seen deals in the industrial space, triple net leases, and a number of other strategies. We've also seen open-air shopping plazas. That asset class trades at cap rates substantially higher than multifamily and storage. So deals exist in primary debt, secondary debt, preferred equity, and common equity. So Tempo Income Fund is more conservative, a little bit more focused on first lien and very conservative equity. And Tempo Advantage Fund is a little more opportunistic. This fund we launched earlier this year with a simple objective to provide rescue and recovery capital, as well as gap capital on some new deals. So as you know, what has happened in the last few years, right? The market with higher for longer interest rates took it on the chin in a big way. Many deals are completely no good. They are in terrible shape. It's a transfer to the bank or distress sale, right? But there are plenty of deals that are decent. In other words, they are more steady eddy markets. They didn't fluctuate as much, typically Midwest versus Sun Belt. And they're also there's significant value add that's being executed, but they're short on liquidity simply because the higher debt service that wasn't budgeted or cap rates expired, etc. So liquidity is justified by the underwriting and the equity behind the still equity cushion in these deals, either because the equity has been created through forced depreciation, or it was bought right, or a mix of both. So the deals that justify rescue and recovery capital provide very, very attractive returns to investors, and that's what Tempo Advantage Fund is doing. We're also doing some new loans in the form of gap funding, interestingly enough. New deals, new ground-up constructions. We did a loan in San Antonio where they were just short a little bit of money. They raised equity, but not enough, and they need to close. It's one of these situations where when the equity raising is tough and the bank's lending less, they are in a position they can't execute the business plan. They can't close, even though the project makes sense. So we did a bridge loan for a little bit of money, 6 to 9 months bridge. It's secondary loan, not primary. So the Tempo Advantage Fund is basically playing in the secondary debt space, mezz debt, but it's lending at the rates of 20%, 18% points, sometimes other benefits. So it's a more attractive risk on a just risk adjusted basis. We see it's a great opportunity, but it's a risk profile a little bit higher. The target returns are higher to investors. On the conservative side, that's where the income fund operates. Does this make sense?
Yes, it does. That's a safer position in the capital stack. Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com. Do you mind explaining a little bit about that? because I had someone on a couple months back that was preferred equity, and they were assisting builders that just pulled COs going into permanent financing, and making up that difference for the new loan with a preferred equity piece. Can you explain how mezzanine financing works, and kind of maybe how the similarities to it, and maybe differences between that and preferred equity that we hear, where, and kind of how that lines up in the capital stack for listeners that might not know? They might just be thinking there's a debt piece and there's an equity piece, and these are much more strategic strategies.
Yeah, Charles, great question. So there's a lot of similarity between mezz debt, secondary debt, and preferred equity. It's just what you call it, right? We prefer to be in that space for multiple reasons, but we could play in the preferred equity, and sometimes primary lender will not allow secondary lender. So we've come up with creative ways to still be a lender, but at the same time, there are deals where only option becomes injection of preferred equity. But it's the capital that comes in between. It covers the gap. That's another term, gap funding. Uh, again, more conservative first lien lending, harder to raise common equity. What is the solution? Well, the solution is to bring in preferred equity. I'll give you an example. We are working on a new equity deal today where it's a significant mixed-use, super Walmart anchored retail, and then there's 345 apartments above that. Right? It's a significant asset, and there is a preferred equity Japanese conglomerates coming in, and they want to play equity. They want to get returns a little bit more commensurate with the equity profile, but at the same time, they don't want to take common equity. So they're coming in with a 12% preferred equity. I looked at the deal. I said, we're lending the money at 20%. These guys are coming in at 12%. We'll take that money. It's a very, call them soft preferred equity. So the preferred equity concept is to bridge the gap on the capital stack for investors in preferred equity, or people who participate in that. The risk level is meaningfully lower, and how much relative to the total equity. So if you think about this, I've seen these scenarios. You could have, let's just say, total you need $20 million. I've seen $10 million preferred equity, $10 million common equity. Sometimes I've seen preferred equity 7 million, preferred common equity being 13 million. So the ratios could be 2-to-1, 50-50. They vary. Sometimes it's in the reverse direction. When preferred equity was aggressive, they would provide 60% of the money, and the common equity will only put up 40% of the equity money. So it's a mix. There's no right or wrong. It's just the capital that comes in, typically with seniority of the cash flows, seniority of return of capital. And we like that. And as a lender, the reason we like more mezz debt than the preferred equity is preferred equity, if the deal is not going great, sponsor or the operator can suspend distributions on preferred equity payments. They can also, there's no finite date. So our preference is to be a lender with a term maturity. And what happens in one term maturity, we have a number of remedies if we don't get paid. So from our perspective, being a lender is a little bit more attractive simply because it basically gives us more optionality. Also, interest payments are contractually guaranteed payments. Preferred equity payments are, generally speaking, are up to the manager of the project. Does this
Makes perfect sense.
sense? Yeah, and I'll add one more point. These other things why we like that. We have a lot of investors in our funds that use self-directed IRA investments. When they invest in a fund that loans money, it has no UBIT risk. I don't know if you ever heard of the UBIT risk. It's unrelated business income tax. So if an IRA money invests in equity, it has a risk of a UBIT. When you invest in debt, there is no UBIT risk by definition. That's why we like debt. Now the drawback is we can't get any depreciation. That's one negative of being a lender. You get income, and you can't use the depreciation to offset interest income. So the source of from a taxation perspective, it might have some disadvantages if you're using cash, but advantages if you're using IRA. There's no perfect world. It's a trade-off. Sometimes preferred equity makes sense. Sometimes mezz debt makes better sense. But conceptually, it's the middle of the risk tier on the capital stack. Does this make sense?
Yeah, it makes perfect sense. Yeah, mezzanine, as listeners can understand, that means middle, as in mezzi is like Italian means middle too. So that's kind of how they got it. But it's people can understand that. But I always think that preferred equity, mezzanine financing, this is really where the smart money plays. And I think it's like you have a lot of family money goes in there because you're getting part of the deal. You're not getting low returns of being senior debt, but you're also getting your money out much faster than common equity. And that's kind of how I see it.
The words of the wise. The words of the wise. I concur with you 100%. I have this phrase. When we do these mezz loans and preferred equity, you're getting equity-like returns without equity-like risk. And I mean this with all due respect to common equity. We play in the common equity too. But think about this. When we're loaning the money at 20%, a couple of points, sometimes we get even a small equity kicker. It feels like equity-like returns. Now, equity, if it does really well, it can get to IRR of 30%, right? But we don't want to take that risk. That's why it's equity-like returns without equity-like risk. That and you getting in this environment where there is a very significant shortage and a big need for this type of capital, you can, I don't want to call it dictate the terms. We don't loan to own. We're trying to make sure that the project is successful. But these rates of 20% are absolutely the norm today. Before pref equity conversations, they were 12, 14%. And some lenders are still coming in some of these shops and they're still deploying money at 12 to 14. We can do it at 20. That's why it feels like a great, really, really smart money today.
What can you explain what you said when you said kicker? Because that was something that just I don't think I've really discussed on here. Why with preferred equity they're going to get paid usually a set rate monthly or quarterly, and then they're going to get possibly, if the deal is successful, some sort. Can you explain a little bit more in depth how that works?
Sure. So preferred equity, you would get your preferred rate of return. And just to be clear, preferred rate of return are not necessarily all paid in cash immediately. Like, give you an example. Today, we are loaning 20% money. We require 11% current pay, 9 deferred. But also, we require an equity kicker in the form of an additional promote. So usually the capital stack works that you have to repay preferred equity with their preferred return. You have to repay common equity with their preferred return. Right? Every dollar above that essentially becomes a profit on a project after pref payments and return of capital. You can get a piece of that upside. So equity kicker simply means you get a piece of the promote, as they call it, on a project, or performance fees. It's all a function of negotiation. There's no right or wrong. You're not getting a big fat piece on that. You can get. So I've seen equity kickers or promote pieces vary from anywhere from a few percentage points all the way to 30% on a project. Usually you're not going to get a bigger piece. There's no right or wrong. When we do these loans, for example, we ask for small equity kicker because most of our return is coming in the form of preferred return. So if we were charging, for example, preferred rate of, let's call it 14%, we'd be asking for a bigger equity kicker. But if we're asking 20% preferred return, our equity kicker, well, we ask for like 5%. It's not a big number.
And it's also taking that on the back end allows the deal actually to be successful, because if you're really bleeding that deal, everybody wants the deal to work out, or like, we want everybody to get paid. I saw like an offering for preferred equity that was 7 and 5. So they're going to get 12, but they're getting 7 up front, and then they're going to get their kicker of 5 on the end for whatever the specific deal was. So you don't like bleed the deal in the beginning. However, you are getting, you know what I mean? It allows the deal to be successful, and then afterwards, once you have that liquidity event, you could then split funds as need be with everything else, everybody down the line.
Yeah, exactly. And I'll add that one comment, 7 and 5. So compare and contrast. People do 7 and 5. We do 11 and 9. This is for the funds, of course, for example, for Tempo Advantage Fund. But we give our investors 80% of effectively all that. So now investors' target return is around 60. It's an 8 pref, 2% management fee, and 80-20 split. This is how the fund functions. So literally how it functions. And I get allergic reaction to sometimes sponsors' offerings when they start talking about 7 and 5. They're in full control. It's really those terms, and I mean this with all due respect, are really for the mom and pop investors, not institutional investors. We're not large institutional, but we are still institutional. We are professionals. So as when the market was good and healthy, everybody marketing these 7 and 5 preferred returns, fixed upside, but there was still risk. If you're participating in preferred equity or mezz debt, in this environment, return targets have to be meaningfully higher, not at 12%. As I said, we're loaning at 20, we passing to investors 16, and that's the market. I mean, why would you want to earn 12% return in preferred equity or mezz debt when you can do it in primary debt? In primary debt, we're loaning money today from Tempo Income Fund at 14%. Used to be 12, now 14. And I say, how we do it? Well, we don't have a large money problem. More competitive lenders might be loaning 10, 11. We deploy the capital that we manage, and our borrowers don't mind paying a little more because of the predictability, reliability of our relationship with them. So if you can earn 12 to 14% primary debt, why would you want to earn that in preferred equity? It has to be higher. 16%, returns have to be commensurate with the risk. That's the bottom line.
That's exactly correct. One thing, Mike, you spoke about earlier, and when we were talking about how you're getting started in real estate, you were talking and you touched on the investment cycles. And I want to kind of, if you can drill down a little bit more into that, and can you break down the 4 stages of the real estate investment cycle and kind of where we are today?
Sure. So 4 stages of every investment cycle is typically, well, let's start with recovery. So recovery after, and it goes full cycle. So recovery, then you have expansion, then you have a hyper supply, and then you have recession, and then again back to recovery, and it goes around and around. So these are the 4 stages. Different assets are in different parts of the cycle. There's no right or wrong. So we've seen commercial real estate, many commercial assets, because of a higher for longer interest rates. Multifamily is one example. Storage, number of other asset classes. I'm not even talking about office. Office is absolutely in deep recession. COVID destroyed that asset class. Right? It's a fundamental breakage of the strategy. Now, of course, every property is local. There are plenty of Class A new office construction that are doing just fine. But in general, that asset class is in deep recession. Multifamily is in deep recession at this point. Not as bad as office, but it's in recession simply driven by the higher for longer interest rates. Storage, all local, but plenty of deals that have been oversupplied. An oversupply problem is fundamental. If you have a storage facility built next to your facility and it's annihilating pricing, the storage wars. The REITs are competing brutally just to get the occupancy. So certain asset classes, and they're really, it's all local. But we see general commercial, many sub-asset classes are in a recession. You have some asset classes that are sort of in hyper supply beginning to move down. We've seen some of the stuff happening in residential, although residential has been hugely resilient to the fact that people just don't want to move. Supply is very limited. But certain parts, certain regions of Florida and Texas are beginning to oversupply of product, and they're genuinely no oversupply. So it depends. There's no right or wrong. It's local, really. Then you go into some really interesting other asset classes. Industrial is pretty solid across the board. Of course, it depends on where you are. We love open air shopping. Open air shopping seems to be doing really, really well because supply, new products, has been very limited for many, many years. Been very few new plazas built. Old malls, yeah, they've been losing steam and converted to storage, et cetera, pickable courts. But open air shopping, great locations have done really well. That asset class feels like it's still in some kind of expansion part. And we might see recovery soon with interest rates going down. Right? We're recording this in mid-August. First cut likely in September. 10-year Treasury yield is already showing significant move down. So give it enough time, the interest rates are going to come down, and we might see recovery. So again, those are the 4 asset classes. It depends on where the property is at, but generally speaking, a lot of things in commercial real estate is in a recession simply because of the high for longer debt service. Not the interest rates, I'm sorry. High for longer interest rates.
You were mentioning retail because you're talking about that deal you guys were doing earlier, a mixed use deal, and retail is an interesting asset class. They haven't really built built a lot of it in the last 10 years, and it's very interesting. People always thought it was going to be dead. Amazon's going to kill it, and it didn't get built. And now it's something that when I talk to brokers that deal with it, they're like, it's extremely low vacancy rates on these properties.
Exactly. And I'll tell you this, we've been investing in open air shopping for many years, very, very successfully, exactly for the reason everybody was afraid of the Amazon effect, e-commerce. and these assets have been trading at much higher cap rates. So cash flows are better, returns are better, et cetera, et cetera. But something interesting has happened. As multifamily got beaten up, a lot of money shifted, and retail is more competitive now. It's more money.
Yeah.
It's a trend. People are following the trend. But you got to be a contrarian investor. When the trend is at the peak, I'm not saying there's anything wrong with we still love that asset class, but there's more bidding wars in the open air shopping and better deals in multifamily. What's really fascinating is it's harder to raise capital, it's harder to find deals, but the better opportunities now are likely to be in the asset classes that have been beaten up significantly. So from that perspective, if you're looking for contrarian deals, that's why we love this deal, because it's got 345 doors multifamily that's got significant discount, right? And it's fairly new build. So also risk profile really depends on, it's a 40-year-old property, class C, or is this newly built class, let's call it B, maybe B plus, new build. And interestingly enough, when you look at retail, you really have to look at the current mix of tenants. When you have a super Walmart occupying 90% of your retail space with a 11-year-old lease remaining on the contract, you have crazy downside protection. Effectively, super high quality credit tenant, and predictability of this type of investment is very, very high. They have it's triple net lease, rent escalation clauses. So that's why we love it, because it's very, very predictable. Now, multifamily, now you could get great deals on that deal. Just for comparison's sake, it costs about $400,000 per door to build, and they're buying it for about $190,000 per door on multifamily front. So things like this, right? You got a deal. It's not necessarily guaranteed returns. There's still uncertainty, some risk, but you can get pretty comfortable today with a deal that looks very, very solid on many fronts.
Yeah, and having an anchor tenant like that is it's similar to having buying almost treasuries. I mean, it is a very solid it's a very solid anchor tenant to have in your property. Mike, as kind of as we're finishing up here, I just had you've been investing many decades in real estate. You see a lot of deals. What are some common mistakes maybe you see real estate investors make? And these could be maybe passive investors or active investors, but what are some common things you see? And then we'll wrap it up with your information.
Sure. So bright and shiny objects, that's the most easiest way to describe. But yeah, but it really starts with even knowing your investment mandate. We are in the same boat as many investors. Why? Because we run funds that invest. We have a goal, we have a mandate, we have underwriting criteria. We know what we are looking for. When there's a deal in front of us, the first questions we ask, does it even fit into what we're trying to do? Does it fit in the income fund? We have other funds. We have some closed funds that no longer raise capital, so can't put them there, right? So we basically try to understand, does it fit investment objectives from a risk return perspective, from the cash flow perspective. Too many people don't even have that. They don't build the investment mandate, their plan, and as deals come in front of them, they kind of go look at them, and that's where the bright and shiny object syndrome kicks in, because somebody sells them well. So a brilliant salesperson comes in with very well marketed deal, and they don't even know how to underwrite. Right? That's so errors that I see: not really knowing how to underwrite, not knowing how to do due diligence, not having a mandate of what they're trying to invest, and and then obviously responding to the things that the market brings them, and the corresponding benefit of the reverse side is you can actually build predictable income focused portfolio. Or if you want to be in a growth with tax benefits, we could focus on that, but you have to understand your risk profile. So as long as you know where you are going, what you want to achieve, your goals are pretty clear, your risk tolerance is pretty clear, you could build a very successful passive portfolio, even with volatility of things going up and down. And you have to understand the difference between debt, primary debt, secondary debt, and there are opportunities to do really well with a lot of predictability and avoid mistakes when you understand your goals, your mandate.
Yes,
Does this
yes.
make sense?
Yeah, thank you very much. A lot of great information there. So, Mike, thank you so much for coming on today. How can our listeners learn more about you, your podcast, your funds, everything about Big Mike?
It's very cheesy, but it works, right? So Big Mike, right? People call him Big Mike. I'm a fund manager. So bigmikefund.com. But that easy. It's not a corporate site. It's just a lending site. It talks a little bit about me, some of the stuff, things I do, but we have a corporate link from there. So bigmikefund.com. And if you misspell it, if you just heard me and you didn't hear the D at the end, just heard bigmikefund.com. I promise it's not a kinky site.
Well, thank you so much for coming on today, Mike. Looking forward to connecting with you in the future here, and I'll put all your links into the show notes.
Thank you, Charles.
Hi, guys. It's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars LLC exclusively.